Guys, believe me or not, this one pizza stock, it has outperformed most of our portfolios, and it's not an AI stock that has given outsized returns. It's just a general store stock that happens to be selling pizza on gas stations. So you might know about the Casey General Stores, or you might have seen them on your drives. It's an American convenience store and fuel chain famous for its pizza. But the thing is, it has produced outsized and exceptional shareholder returns. As you see the video, you are gonna realize this anyways. And I have made this presentation, and the thing is, it's not really as simple as a gas station pizza that people happen to be loving, but we'll go through the details, guys. But I must tell you over here that Casey has built a sophisticated combination of fuel retailing, high margin restaurant food, convenience store merchandise, rural marketing. Dominance is also something that is giving them some edge. Logistic and distribution also seem to be on point, and they also have some loyalty program as well. And although the acquisitions, however, or how large they might be, the thing is, the acquisitions are disciplined. I'm talking about the customer acquisition. But by the end of this presentation, you'll realize that some of the greatest compounders, these are ordinary looking businesses with the extraordinary unit economics, which we are going to see in this presentation, guys. And now we need to see what exactly Casey's is, and what's its history, so that we can understand the business. So they began operating in Iowa in the late 1960s, and they introduced a made from scratch pizza in 1984, as you can see on the timeline, and they launched its breakfast pizza in 2001. Now, Casey says that breakfast pizzas later grew to more than 2.5 million orders annually, and it's now America's third largest convenience retailer and fifth largest pizza chain. That in itself, guys, is a huge thing. And as of making this video, the market cap of this company is 30.8 billion US dollars, and the company has 2,944 stores, and it's operational in 19 states, which I think is quite a feat. And it has some 50,000 employees, approximately 10.5 million reward members, which I told you about the customer acquisition a little while ago, and approximately 800 million annual customer transactions happen in their business, guys. Huge number. And 71% of the stores, they are located in communities with less than 20,000 residents, guys. This gives me the vibe of like a Walmart in the making. And the annual revenue for FY26 was 17.56 billion US dollars. And other than that, I must tell you that the rural concentration for Casey's is important, because it often operates where large national convenience stores, restaurant, and supermarket chains have limited presence. So they are tapping into that business market. Now, the moment of truth, guys. How much has this business returned in the last 3 years? So, if you invested 1,000 in it in 2023, you would have 3,490 US dollars as of now, and the share price grew from 228.8 to 822.15 as of making this video. And I also have to show you this chart. Have a look at this chart. It's a 5-year chart, and if we look at the 10-year return of this business, it's 559% 10-year total return. So it means that 1,000 invested in this business would have become 6,590 US dollars with dividends reinvested. What a great business, guys. It has proven itself to be. Now the thing is, has this business beaten the broader stock market? That is true, guys. And I just turned on this max time scale option, and you can see it's up by 19,529.86% from its listing price. Insane, guys. And I must say that it's also a fair conclusion that it's one of America's strongest non-technology compounders. People would agree with me on this one. Now comes the important point of their earning, and you can see since the last 3 years they have grown it year on year. The revenue has increased, and that to me is one of the very important indicators of a good business. And even if you look at its earning per share, it has also grown over time. FY26 revenue was 17.56 billion US dollars, which happened to be 10.2% more than the year before. And another thing is that their earning before interest, tax, depreciation, and amortization (EBITDA) is 1.48 billion US dollars, which is up 23.6% compared to the last year. I've not included that graph over here, but just to let you know. And their operating cash flow also increased by 26.3%. And in the last 1 year, they have increased 40 stores all across the US. And in their last 3 year strategic plan, which had an ambition to target 350 additional stores. Casey's actually added 504 stores, and it significantly exceeded the target, guys. I think is pretty important, and you need to understand the economics here, that the fuel that they sell, it's almost 4 times less of a margin earner compared to the prepared food, and the grocery, it lies somewhere in between. And the interesting thing is that 36% of their revenue comes from the food and grocery. So fuel brings the people to the gas stations, and then these are what contribute to the profit. So it equates to some 62% of the financial year 2026 gross profit, guys. And the competitive advantage that they have is that their rural market dominance brings them a lot of business. Approximately 71% of the stores are in towns with population below 20,000, and the market can be too small for several national restaurant and retail chains, but well, it is definitely large enough for one well operated Casey's. What do you guys think? And according to the management of Casey's, what we know is that roughly half of its location do not have a national pizza or wing chain within 5 miles. So they do stand out, guys. Now, this local relevance and limited competition and an industry that is fragmented, these are the ones who are filling the gap, and they have room to compound. Now, guys, their business is also fairly simple to understand, but it's not easy to implement. What they do is they acquire regional and family owned stores, then they install kitchens in it, and they add pizzas, wings, and fresh food, and then they connect the distribution and merge it with the Casey's rewards. And after that, after doing all that, they get to have higher margins and they can scale the profits. So in short, it's acquiring, upgrading, and then digitizing, and it essentially lifts the economics of the locations. Now, guys, the financial year 26, it benefited from some increase in the fuel margins. Now in future, what I think is that fuel margins could normalize, and the wage and the ingredient inflation, it could catch up. Acquisitions themselves also have a cost, so that could drive the margins a bit low in future. But for now, these are, I would say, hidden risks. The company itself is doing really well, and guys, it's trading at more than 40 times the reported earning. That's its price to earning ratio, and the annual dividend yield is also quite less. Not a good stock for the dividend investors. And from their earning report, we can see that 722 million US dollars is the free cash flow that they have available right now. They are sitting on a lot of cash, actually. Now, these are some extrapolations. Now, if the earning per share grows at 10% annually, and I feel like they have a history of increasing the EPS beyond 10%. So, if they keep on doing that, then at a 40 price to earning ratio, which is also less than 43, which is right now, they could be sitting at a share price of 1020. And let's say the price to earning ratio decreases down to 30, you can see the stock price will be 765 US dollars. But right now the share price is 828. Now, guys, what we need to understand is this question over here, that can the earning grow fast enough that it offsets the lower valuation multiple risk, like I explained to you over here. That is the question that we need to look into. And guys, if you are new to the channel, just subscribe and I'll sum all of this. And to conclude, right now, I'll tell you this part first. So, what it has given in return, that has been received by the shareholders already. Their stocks have increased in price. So, it doesn't mean that you can now get this sort of return. The one you see here, 249%. And now, more important than ever, the fuel margins. We have to keep an eye on those. And I think that you should put it on your watch list if it wasn't on your watch list before. But the good thing that they have a higher margin food business, and their rural competitive moat also stands out, and they are increasing their numbers of stores quite significantly. So if I once again summarize after summarizing all of this, so it's a second summary. So business quality is, in my opinion, excellent. The competitive position, like I told you, it's fairly decent. The growth runway right now, it's attractive, but it's not the most attractive that it has been, because the historically great returns have been reaped already, and management seems to have executed in an impressive way. Balance sheets are manageable. Dividend income is very weak compared to the current price, and the current valuation, I think it's kind of expensive. So for me, it's like a high quality watch list company, not a direct buy at this point, and you people have to look into it for your own self. I think I've explained enough for you people to take a step in this direction that I intend you to go towards, to look into this company and put it on your watch list. And if you do have something to say, I would love for you to let me and everyone else know down in the comment. We'll see each other in the video that YouTube is showing here. Don't go anywhere else, guys. Watch that video.